Good morning and welcome. Today we have special guests from the professional services firm of CLA. We have Kevin Tomalty and Adrian Gomez. Now, while everyone is coming into this webinar, I'm going to go over some housekeeping items. We have a number of webinars coming up this month. Next week, 10 a.m., May 3rd, our president and CEO, Anthony Antone, he's going to host a live CEO podcast. We will also have our friends from IBA talking about buying, selling, and holding hospitality businesses at 10 a.m. on May 10th. And on May 17th, we'll have Rick Braw here talking about labor management. If you have any questions, you can go ahead and type them into the Q&A and we can answer them on air. And yes, we are recording this presentation, so we will have it up on our YouTube channel or wherever you get your podcasts along with their slideshow presentation. And with that, I'm going to hand this over to Adrian and Kevin. Welcome.
Yeah, thanks, Lisa. I'm Kevin Tomalty. I'm a manager with CLA. I sit in the Wenatchee location. And then I've got Adrian Gomez with me here, and he's head of our retail practice for the entire Northwest, and he sits in Othello, Washington. So we're going to talk about kind of four just very distinct things today, but three of them are opportunities, and then one is just kind of a hot topic these days, the Washington capital gains tax. So stick around till the end for that one. So Lisa, you can go to the next slide and we'll talk about entity selection. Just give me 1 second here to something happened with the Zoom. I'm good. Okay. So talking about entity selection opportunities. So the big opportunity here is to save on self-employment tax. And so your simple kind of your default status if you start a restaurant or a business of any type is you're going to become a sole proprietorship, and that gets reported on a Schedule C on your Form 1040, your individual tax return. So you kind of default into this status. Even if you're an LLC, you'll default into this status without making any other kind of election. And like the name suggests, it's a sole proprietorship, so you don't have any other owners in this. It's just you. In Washington State, it can be you and your wife, called a disregarded LLC. And they're really simple, really easy to set up in the sense that really all you got to start doing is hang out a shingle and start working. The downside to these is that you're required to pay the self-employment tax, which is really essentially a 15% surtax on the first $160,000 of your profit. So you're going to pay income tax, but then you're also going to pay self-employment tax on top of that. And so the big opportunity here is if you're going to have a pretty profitable business and you're set up as a sole prop, there's some ways that you can save some money on self-employment tax. And at 15%, I mean, it pays for itself pretty quickly. So and I want to mention that an LLC, because I get this a lot from clients and just people who are interested in learning more about this, is they think that the LLC itself is a tax designation, and it's really more of a legal thing. There are tax implications for an LLC, but an LLC in and of itself does not necessarily change the way that your business is taxed. You have to make elections or decisions beyond just becoming an LLC. So, and I'm not an attorney. You're not my clients, but there are some pretty compelling legal reasons to look at an LLC, even if you're still going to stick with a sole proprietorship. So an attorney could expand more on that, but the next option would be a partnership. Also, these are also pretty simple to set up. Really, if you have multiple owners, and obviously in a partnership by definition, you have to have more than one owner. You would default as a partnership in the IRS eyes. And these, so again, simple to set up. Basically, you've just created a partnership with somebody else. You start business. You get an EIN from the IRS, and they're going to respond based on your information that you have two owners that aren't husband and wife in the state of Washington. You're going to default to a partnership. The thing about partnerships that can be I guess, kind of fun or just interesting is that although they can be very simple and they're really simple to set up, they can also become extremely complex, which can be a good or a bad thing depending on what you need. The good part of it is if you are in a situation where you want, you have, maybe a silent partner who's just an investor, and then you've got active partners, you can really tailor how the profits of that business, even how the losses of that business, and then how the dividends or the distributions of the business are doled out to each partner based on, previously agreed to agreements. So there's a lot of room for flexibility. And the other thing is there are certain instances, talking about saving on self-employment tax again, where if you have just the right combination of partners who are active and passive, and I won't go into all of what's involved in that, but there is basically proposed IRS regulations that have been in place for years in which the courts have upheld that state that if you have enough of passive ownership in a partnership, you can basically avoid a lot of self-employment tax. So maybe to back up a step is if you have a general partnership, all the income is still subject to self-employment tax. But if you can come up with a limited partnership where you've got passive owners, you can basically move a lot of income to passive owners and avoid the self-employment tax on that portion of it. So what you see commonly set up is you have a 1% manager in a partnership. So he owns 1% or she owns 1%. And then you've got 99% of the partnership is owned by passive owners. And the way the regulations are written, that passive owner can actually be the same person that owns the 1% share. So they would have an active ownership portion, and then they would have a passive ownership portion. And so instead of having 100% of your income subject to self-employment tax, you can get it down to the point where you have 1% subject to self-employment tax. And then moving on from partnerships, S corps would be, S corps are often what we end up recommending to a lot of people because they are, in the grand scheme of things, they're still pretty simple. I mean, they're more complicated than a sole proprietorship. They can be more complicated than a partnership. But the nice thing about S corps is that you really can save a lot on the self-employment tax piece compared to a Schedule C. So, and like I said, they're still really not that complicated. In some ways, they can be kind of simple because the regulations are pretty strict, but then that becomes a potential con depending on the ownership's kind of situation and how profits want to be handled. But if everybody's good with being pro rata, so you own 50% of the business, you get 50% of the profits, you get 50% of the distributions, then an S corp is really an easy way to go. And then this goes back to that LLC comment. So an S corp, you can be like incorporated and make an S election. So basically you go from being a C corporation to being an S corp. But you can also make an S election as an LLC. So you don't have to be incorporated to become an S corporation. An LLC can do it. And so it's one time that the LLC status does matter for federal taxation because you cannot be a sole prop without an LLC in place and make an S election. Then the other thing about an S corp is that there's a certain kind of threshold where if a business isn't making that much money, we don't necessarily recommend an S corp right off the bat because there's more overhead that you're going to pay. You've got to have a tax return prepared for the S corporation. You've got to run payroll for the officers, although in most cases S corps are already running payroll anyways, so that doesn't add a lot of burden, but it is one more thing that needs to get done. So there's kind of a break-even point where it's going to start to make sense to become an S corp. And then the other thing that's kind of fun about S corps and that can make for some interesting conversations when is you can do late elections, and there's, a lot of rules around it, but it's an opportunity that really is available as long as you basically play your cards right. And so like somebody may have started a business and they didn't really know, which route to go or whatever. Or a lot of times what I'll see is like somebody started a business and they thought that they were an S corp, or at least they thought they were basically the substance of an S corp is what they were doing, and they didn't realize that there was an election they had to make. And so in those cases, you can actually go back and make an S election You can go back as far as like 3 years and I think it's 25 days, 3 years and 25 days in the past and make an S election if certain requirements are met. So um, anyways, that's where we end up landing a lot with businesses that are pretty successful, that are making pretty solid net income each year. Is let's make an S election, get out of all that self-employment tax. We do have to pay the officer, which 95% of the time is the owner of the corporation. You got to pay them a reasonable salary, which is where the IRS kind of claws back some of that self-employment tax because they get it in the form of payroll tax from the owner's W-2, the owner's wages. But it's still, at the end of the day, it's really a big net saving. So, and then the other option out there that I didn't mention is a C corporation, which you need to be incorporated. Usually not our first recommendation, but there can be situations where they make sense. One of them being if income is just so high every year, year after year, there's really the self-employment tax savings doesn't really come into play, or you're in the top bracket regardless. So in those cases, C Corp can make sense. And a C Corp is the only type of entity here that is not what we call a pass-through entity. So a sole prop, a partnership, and an S Corp, all that income is going to get taxed on the owner's personal tax return. So the S Corp or the partnership doesn't pay the tax itself. That income just passes through. I kind of refer to the partnership return or the S Corp return as an informational return. Basically just telling the IRS, here's what they made, here's what you can expect to see on their personal return. And then you report the income on the personal, and that's where the tax gets paid. With the C Corp itself pays the tax, and they're basically treated legally as a person and not as like a business. And so C Corps pay a 21% income tax, but any dividends, so any money that you take out of that C Corp and give to the owners gets subject to a 15% tax as well. So if you take 21 plus 15, you end up with a 36% effective tax rate. So like I said, that a lot of times that doesn't make sense. It's not worth it. But there are scenarios out there where that can come into play. So there's a really quick and dirty overview of entity selection. Lisa, were there any questions that popped up on that?
Nope. If you're here, go ahead and feel free to type any questions you have in the Q&A section.
While you guys are doing that, we can move on, and Adrian's going to take the next spot here.
Great. So the next topic we're going to talk about is the FICA tip credit, so Form 8846. And this all relates to something that you're probably already doing most of this. It just comes more are reporting it and utilizing the opportunity and the benefit of the tip credit. So the tip credit is basically claiming a credit for the employer Social Security and Medicare taxes that you're already paying on the tips that your employees are receiving. A tip is a form of compensation that technically your customers are paying your basically front of house employees. The credit's available to anybody in the food industry or beverage industry, kind of their regular tipped type of employees. It's calculated based off of the total tips to the maximum amount of the employer Social Security and Medicare wages, which I believe in 23 is 147,000 or something like that. So if someone's receiving more than that, there is some limitations there. But normally our front of the house probably aren't earning that type of earnings. To be eligible for the credit, you must have paid or incurred these tips. So basically is not where we can play with deferred tips or anything like that. It's once they're incurred or they're paid, then we're eligible to take the credit on those tips. You should keep accurate records, just like anything else, of the employees who are receiving, how they're receiving them, and how they're reporting them. One, to be able to add them to your Form 9041s, the W-2s, all the payroll related forms that need to be filed. So then the other thing about this is when we take this credit on either your individual return, if you're a sole prop, or if you're If it's a pass-through entity, it's a flow-through item. It's a credit that gets generated and then gets input to the owner's tax return. But let's just say if we have a credit of $10,000, we would have to reduce our tax expense by that 10 grand. And then we get a dollar for dollar reduction from our income tax for that 10 grand. So it's still a net benefit, even though you might pay a little more because you're reducing an expense, but then you get on the back end, you get the basic, like if it was withholding or income tax paid to the IRS. The one thing on these that we got to be careful with is the automatic gratuities. So when you have service charges or service fees for large groups and so forth, those technically are not considered tips in the eyes of the IRS and should not be included in the tip credit. The tip credit is 7.65%, which is the employer share of Social Security Medicare. So if, just from a quick illustration standpoint, if we've got, at the end of the year, $100,000 of tips, you got $7,650 of potential credit there available to you. And what we've seen from just, new clients coming in, or whatever, is a lot of times it's an overthought. We focus more on, hey, you've got to file our tax return, but we don't look at the opportunity of, are we filing this form 8846 and getting the benefit of basically 7.65%. It's just, it's just low hanging fruit, dollars that you're already paying the FICA Medicare. So it's just a matter of following the path, following suit of filing everything to get this credit, from your share of FICA taxes that you're technically paying because a customer decided to give a tip to your employees. So just one thing to kind of keep top of mind, or look at your tax returns to see if you're actually filing Form 8846. If you're a sole prop, this will generally come through as a general business credit on Form 3800. But it's something just to maybe talk to your tax practitioner and see if you guys are taking advantage of this opportunity.
Adrian,
So that's
yeah. Just going to ask you a question, tee up here. So say that I've got income tax that I owe of $12,000, and then in your example, I had a $10,000 tip credit. How much would I actually pay in tax?
So is your $10,000 after adding back the reduction of expense?
Yep.
So your tip credit was for how much though? We're using that 100,000.
I'm going to say that the credit itself was just 10,000. Keep it simple.
Okay, so if your total tax liability is 12 grand and you hit your tip credit computed to be 10 grand, you would just have a 2 grand that's what it'd be due. So basically it's a form of payment of tax in the form of a credit.
And then let's switch it up and say the tip credit's still a 10 grand, but I only owe $8,000 in tax. Do I get a refund for $2,000, or what happens with that over the amount that it's over?
It gets carried forward to the following year. So it's a carry forward. It's not a refundable credit. It's something that it reduces tax, but it's not refundable. Kind of in line like a lot of other credits that are out there.
Yep.
So I'm not sure if any questions arise there, but if not, we could move on to the next one, Lisa, which is another credit. Maybe back up to, you might have went too fast on the.
Oh, there it is.
There you go, right there, work opportunity credit. So this is another credit that's available for kind of more incentivizing of hiring some select individuals that the government's out there. And you can see the eligible employee groups, long-term unemployment recipients, short-term TANF recipients, qualified veterans, disabled veterans, unemployed, ex-felons, food stamp, SNAP recipients, summer youth employees and so forth. So when you want to take advantage of this work opportunity tax credit is on the onset when you're, putting hiring new employees, because this is all related to new employees. You got there's some timing thresholds related to this, but the credit can be up to $9,600 per employee. That's more related to maybe on the veteran classification or long-term TANF recipients. Most of these are going to be probably $2,400. The way that the amounts are computed, it depends on the retention. If they work more than 400 hours in that first year, then you're entitled to the full credit. If they work between 120 and 400, then it's limited somewhat to that. But basically, it's if they work 120 to 400, it's 25% of the first $6,000 of wages. If they work over 400 hours, then it's 40% of the first 6,000 wages in year one. If there is some qualifications for year two, then it goes on into 40% of up to 12 or 24 or 14,000, depending on what group or what target group that employee falls into. All of this, they're on the onset when they apply. There's another form. I want to say it's an 8055 form, I think is what it is, that they fill out that basically has some questionnaires of, hey, do they fall into any of these targeted groups? If they do, then it starts the eligibility of obtaining this work opportunity tax credit. You have to submit that form within 28 days to I think in Washington State's Employment Security Department, where they verify all this information. So that way you've got some documentation saying, hey, this is a eligible employee for the work opportunity tax credit. And once all said and done, you got the qualifications. You look back at the year when you're filing, and you fill out a form that's form 5884 that summarizes the total amount of credits that's available to you. And it's very similar to tip credit. It adds back, it reduces your expense, but then you get a dollar for dollar credit against your tax liability. So both tip credit and the WOTC credit work the same as far as how it's utilized on the individuals, or in case of a corporation, you can also take advantage of this, but it'd be a corporate reduction of its liability as well. So that's kind of a summary of opportunities in the credit world. I know you guys have probably been hounded with the ERC credit and so forth, but we decided, those are stuff that probably have enough information out that maybe these other work opportunity credits and tip credits are not so top of mind. And so it's just kind of a refresher of, hey, these are opportunities that are out there that if you're not taking advantage of, something maybe to look into.
Yeah, and on
So that's
one thing is these aren't going away, whereas ERC was like a one-time deal. But on this WOTC, what I've seen a lot is like people don't even know that they have employees that qualify, and then you do a study, and like even if it's only 2,400 per employee, you get, say you find out you have 10 people qualify, that's a big chunk of credit, 24 grand. So it can add up pretty quickly, and sometimes you don't even know what you're sitting on, so to speak.
right. I would say in the retail, because I know we're in the hospitality here, but in retail, it's probably safe to say that at least 10% of your employees would probably fall into some of these categories, maybe even more. It just depends on where exactly your business is located and kind of what type of or employees you guys are hiring and so forth in that location.
Yeah. Thanks, Adrian. We can go to the Washington capital gains tax. So unfortunately, not exactly an opportunity here, but it's kind of top of mind, and I won't go too much into the history, but basically this tax was proposed or presented, went to the courts, basically got stalled is probably the best word to use, and went to the Washington Supreme Court, and they ended up upholding it. And so it took effect as of January 1st, 2022. So if you had capital gains that were subject to this tax in 2022, you owe tax on them, and if you weren't on top of that, technically you're going to owe some penalties now too. So I think it's going to go to like what do they call it, like a referendum, like a vote of the people. But based on everything that's happened so far, it seems like this is probably going to end up sticking. So this is in place, and most people in an ordinary year of business or of life, they're not going to be subject to this tax. just because it really is focused on people who make a lot of money and who have significant capital gains. But in the terms of kind of this group of people and, you know, hospitality in general, where this could come into play would be in succession planning. So when you're looking to sell your business, there's a good chance that you could be subject to this tax. So it's just going to be one more kind of thing that needs to be considered and thought about in a succession planning scenario. So it's a 7% tax on long-term capital gain as reported on the federal income tax return. And I won't go into my CPA, yeah, my issue between them calling it an excise tax, but deriving it from an income tax number. To me, that doesn't make sense, but it does to the Supreme Court, and that's all that matters at this point. So, yeah, it's 7% tax. It's only on certain long-term capital gains, and it's not on short-term capital gains. So I had a colleague yesterday told me he had somebody who had, I forget what the numbers were, but it was like $200,000 of long-term capital gain and $200,000 of short-term capital loss or something like that. And like it offset in one sense for the income tax term, but for Washington capital gains, the whole amount was subject to the tax. So anyways, it's just long-term capital gain, and it has to be Washington sourced. So if you are, yeah, I mean, basically the property being sold is in Washington, or you're selling stock or something and you live in Washington. So the sourcing can depend partly on what's being sold, and then also depends on where you're domiciled. So as long as you are a Washington resident, most likely capital gains subject to this tax would be taxable to you. So I keep saying subject to this tax because I'll get into it. There's a bunch of exemptions, deductions, and credits. So the first deduction is there's a $250,000 standard deduction. So if you have a long-term capital gain that doesn't get covered by any other deduction, exemption, or credit, and that capital gain was $300,000, you would basically get to deduct $250,000 from it. And so you'd only have a $50,000 gain that was then taxed at 7%. Yeah, and then another deduction is the qualified, it's called a qualified family-owned business deduction. And that one is, there's some stipulations. So there's minimum ownership requirements. You can't have 50 owners in an entity and qualify for this. In certain scenarios, you can have up to 3 owners or family groups that own the business. And then they also need the owners who are there, whether it's 1, 2, or 3 owners, they need to have at least 5 years they've owned the business and 5 years that they've been materially participating in the business. So you can't have like kind of a silent ownership or just an investment partner or ownership in the business and still qualify for this deduction. But as long as you're active, you've owned it for 5 years, and there's not 4 or more owners from different families, then you could qualify for this deduction. And the last stipulation is you can't have more than $10 million in gross receipts for the 12 months preceding the sale. So that does, I think, rule out a lot of people from having to pay this. But if you miss one of those points and you sell your business and there's goodwill in the sale, you're going to most likely be subject to this tax. If you do meet all those requirements, then you basically, the gain that's reported associated with the sale of your business is not going to be subject to this tax. You're going to be able to deduct it. And if that's your only gain, your deduction would bring you down to $0 of taxable income. Then there's various exemptions as well. So the big exemptions that for most people are most pertinent is real estate and personal property. So real estate's buildings, land, those are not subject to this tax. So you sell your personal house, or you sell the land that your restaurant's sitting on, if you've got that in a separate entity or something, that sale is not going to be subject to this tax. And likewise, personal property. So think about like your equipment, your furnishings, your fixtures, vehicles, that kind of thing. They are also not subject to this tax. And then there's a bunch of other exemptions, but most of them get really specific, like timber rights or cattle or goodwill in an auto dealership, or fishing rights. There's also exemptions for things like that, but the big ones are the real estate and the personal property. And then going into the credits, so there are credits for B&O tax paid. So if you pay Washington DOR B&O tax on this, on the same sale, you would be able to take that as a credit. And also for excise tax or just taxes paid in other states. So on that one, I have a client who's lives in Washington but selling an Idaho business, and he could have been on the hook for both Idaho and Washington tax, in which case he would be able to deduct from the Washington tax the amount of tax that he paid in Idaho. And Idaho has roughly a 6% tax rate that he would have been subject to. And so he would have only been paying roughly 1% in Washington state tax on this. We ended up finding a different deduction for him to get out of the tax, so he didn't have to pay any Washington capital gains tax. And then this is an individual level tax. So it doesn't apply to C Corps and it only applies to individuals. But to go back to that first conversation we had about entity selection, if you have an S Corp or a partnership with a capital gain that passes through to you personally, then it's going to become an individual level tax. So just because you've got the gain or the sale happening inside of a different entity, if it's passing through to you, it's going to be subject to the tax. So the only thing I'd mention about this, which probably matters for us more than most people on this call, is that just the process of filing a return right now is pretty clunky. It's all done through the Washington DOR's internal website, and for us as practitioners to try and help clients through that it's clunky is an understatement. So but yeah, there you go. That's the Washington capital gains tax kind of in a nutshell or at a really high level. So go ahead, Adrian.
Yeah, I was gonna say, you were right on the onset. This is a succession planning item. Is something to keep in mind, when you're doing a transaction, are we going to be subject to this new tax that we haven't had ever? Something to just consider, because it's 7% of whatever your net proceeds are, is another chunk that we're gonna have to give away. So it's just one of those things that we can do some strategic planning on how we do something when we sell a business or whatnot.
Yeah, and you can look at allocating the sale proceeds differently, and there's definitely a lot of flexibility in it. And we had it pretty easy in Washington for a long time in terms of succession planning and just income tax in general. Sorry, I shouldn't call this an income tax. I should call it an excise tax. But taxes on income in general in Washington were, we just didn't have to worry about it. And now we've got this this cog in the wheels, or this wrench in the wheels, I guess. So so those go ahead.
We have a question.
Okay.
There are many interpretations of the 10 million gross revenue threshold. Are family businesses that generate less than $10 million in revenue subject to the tax at the time of sale?
If their gross receipts in the 12 months preceding the sale. So gross receipts would be basically you look at your bank statement and you just count up all the deposits into your bank account. That's your gross receipts over those 12 months. If they're less than 10 million, then you can take the deduction for the gain that's associated with the sale of your business. So that's a really roundabout way of saying if your qualified family-owned business has less than $10 million in receipts, you do not owe this tax.
All right, thank you.
If also on that, Kevin, it would be if they have that 5-year participation.
Right, if they meet the other
well.
requirements for the definition of a qualified family-owned business. Yeah. Any other questions on that?
Nope, that was it.
We just had planned on half an hour and then leaving time for questions at the end. So that's the end of our presentation. But more than happy to answer any other questions that come up.
Well, thank you both so much for taking the time to sit down and talk to us about these very complicated issues. For anybody who wants to watch this later, we will have this up on our website and our YouTube channel and our Washington Hospitality Industry podcast, along with the slideshow. And once again, thank you, Adrian and Kevin. It's really a very informative webinar.
Appreciate the invite.
Yeah, thank you, everyone. Appreciate it. The opportunity to come talk to y'all.
All right, bye-bye.
See ya.
Thanks, guys.